760 WJR. Welcome into No Lazy Money with Nick Hopwood, the president and founder of Peak Wealth Management in Plymouth, and Jim Pilat, the vice president of Peak Wealth Management. You can find them directly online, peakwm.com. This is a show where we do not sugarcoat it. We don't let your money sit around and be lazy and do nothing. These are real people, real situations, real money, and real talk. Zero laziness. Nick and Jim take a holistic, comprehensive planning approach, and we're going to do that over the next 60 minutes. If you would like a complimentary annuity review as well, Nick's got you covered. Just reach out, nick@peakwm.com. Mention WJR in the headline, and you will get that complimentary annuity review. Don't go anywhere. It's No Lazy Money, and it's right here on 760 WJR. It's 760 WJR. Welcome in. This is a show where we talk about money. It's called No Lazy Money with my good friends from Peak Wealth Management in Plymouth. Nick Hopwood is the president. Jim Pilat is the vice president. Gentlemen, thanks so much. I really enjoy doing this show with you guys because, Nick, every month we get an opportunity to look in on the market, take a deep dive on some of these different issues that people are faced with as we look towards the future. And welcome in. Happy summer to you. The weather has been fantastic, isn't it?
I love it. I don't want to leave Michigan. I want to be here for the whole summer, at home on the lake, up north, Lake Charlevoix, like you were saying. So, yeah, can't beat it.
Jim, isn't this why we live in Michigan for times like this?
Absolutely. Yeah, absolutely. I'm just happy we finally managed to string a couple nice days together.
Look at that. No doubt. Nick, let me ask you just big picture, first and foremost, before we dive in. The market seems to fluctuate with every Truth Social post or every news event. Gas prices are still high. They're coming down, but they are still high. I paid $4.15 the other day, and I was like, yes. And then I'm like, oh, well, you know what I mean? But people are still trying to figure out this market. What would you say to somebody who is concerned or feeling anxious about this market?
Last week, we just finished May at an all-time high. And by the way, it was an excellent month, followed by, and April was an excellent month, followed by an excellent May. So we strung together these 2 months in a row. We haven't had 2 months, April and May, like this since 2020. So it's we're up here in rarefied air. But like you said, when people are looking at these gas prices, interestingly, consumer confidence is at an all-time low.
Yeah.
So it's very hard to reconcile. You know, last time we talked about the K-shaped economy, the haves and have-nots. People that have assets are enjoying this run tremendously. People who do not, they're feeling a lot of pain tied to that inflation.
Jim, do you have a thought on that?
Yeah, I mean, the market has definitely shown itself to be resilient. You know, whenever the next news topic comes up, whether it was, Iran is the recent one or the tariffs before that and all the different things, the market's been reacting strongly one way, and then we get some positive news and it reacts strongly the other way, and then it gradually settles in and it doesn't react as hard to the news headlines that are coming out. So I think that's a pattern of what we've seen over Trump presidencies. But, it keeps being resilient and there's reasons to be optimistic, even in the midst of valuations being high.
Without question. So let's dive into this show and a couple of things we're going to talk about. Initially, let's talk about this annuity hell. And I use that word. It really grabs you. Define annuity hell, Nick.
Well, Jim can maybe describe a recent case that we worked on, but a local firm in Novi seems to be just putting people in annuity hell. And they came to see us for a second opinion, and we discovered what half the money was being put into new annuities, 5 different annuities, and the fees are out of control, a 10-year commitment on some of these things, and a very limited potential for return, like 3.5% for a cap, meaning that's the most you can make in a year.
Wow.
I mean, gosh, the fees are almost that much. So you're just going nowhere fast. So fortunately, they came and saw Jim and Preston. And what happened, Jim?
Yeah, they came to us as a second opinion. They tried to be really upfront on the phone and say, we just want your opinion. We're not looking to switch or anything. But we said, sure, come on in. We're happy to talk. And just able to point out some of the things that Nick had mentioned already. But what got me the most is how much the product recommendations didn't align with the goals of the client. The client came in and he was talking about how important it was to him to leave a legacy, and they thought they were in good shape financially, and they are, but wanted to make sure the kids were going to get the most. And for them to make a recommendation of an annuity that's never going to make more than 3.5%, and the only way you make 3.5% is if everything goes perfect, right? If every month is a good month, and so on. So it's a really challenging bar to exceed. And his other priority was just wanting to have flexibility, right? He says, we might want to buy an RV, we might want to do some traveling. And if you take, half your net worth and you tie it up in investments that have 10-year surrenders, meaning you can't get the money out without penalty in the first 10 years, there's no flexibility there.
So what's that guy do now?
Fortunately, these insurance companies offer a 10-day free look. So they came to see us within that window. So one call to the insurance company cancels the contract within the first 10 days.
Why would somebody put a client in an annuity like that? Yeah. And I think the message for people listening right now too would be, you want to know that somebody has your best interest at heart when you go ask for financial help with a professional, not that, their financial interest is number one on that list. How would you guard against that for somebody that's just, trying to, maybe you see an advertisement, maybe have a friend that, hey, I worked with this guy and he did pretty good. Like, what would you say to people out there that this guy's clearly working with the wrong firm, clearly for his interests? So how do you guard against doing that?
I would tell all the listeners here, if they're interviewing financial advisors, to straight up ask, what are my fees? What is my total cost of this program, of this product? We don't try to pitch products. We are selling ourselves, right?
100%.
We have the best strategy for you. We have the best plan for you based on what your goals and needs and interests are, not what we think you need from a commission point of view. That is kind of the definition of a fiduciary, right? There are no guarantees in this business, but we guarantee any advice that we give is always in your best interest. So those types of questions should be asked, right? And then, from Jim's point before, I can understand someone wanting a guaranteed income stream. Mm-hmm. Like, people love their guaranteed Social Security and their guaranteed pension. So it resonates, right? Mailbox money. But the problem is, if too much of the money is tied up, and now you want to buy that RV, and it costs $150,000, but you have to break the annuity to get access to the money. Now you're losing the guarantee, paying surrender charges. It's a mess. So if you need to keep that flexibility. And the other thing that I'll add, now that interest rates are up, like, people would buy guarantees, like a 5% for life guarantee. That was when interest rates were zero. Now you can get 5% in treasuries or in regular boring bond funds. We don't need to tie it up and pay all the fees and have all these bells and whistles that you don't need.
That's absolutely an important point. Jim, do you have a thought on that? Because, people will get locked into these 3.5%. If everything goes right, you can get 5% right now, as you said, in a money market.
Yeah. I think it's really important to keep goals in mind, right? The first thing I said, the client, the product that was being pitched to him wasn't matching his goals. So I think it's really important to start with that, making sure that you know the objective of that money and what it's there for and what you may or may not need it for. I think is always the right first step.
Who would be the ideal candidate to be put in an annuity? Like, where it's a good move, or is it, or do you just stay away from it all together?
It would be a hard pitch for me to put someone right now, considering what we just talked about, but someone who truly is risk averse.
Like, I want no risk whatsoever.
Like, they want a CD, they want a fixed annuity, something like this that can't go down.
Another person that I think could potentially be a good fit is somebody that really lacks financial discipline. We have people who, this maybe even translates into, do I take the lump sum on my Ford pension, or do I take the monthly income?
That's a great point.
And there's people that just, if the money's there, they're going to find a way to spend it. So if we can guarantee an income stream, that could potentially save them down the road.
I did a story. We did a story actually a couple of weeks ago on this lottery winner. They had an option to take like $3 million for like upfront or $1,000 a week for the rest of their life, and they took $1,000 a week for the rest of their life because as it worked out, they did not trust themselves with that money because they would have spent $3 million right off the bat and not had anything to show because they weren't gonna invest that $3 million. They were going to spend that $3 million.
This $1,000 a week is a very low ROI.
Right. I know. But the person was like 22 years old and she did not trust herself with $3 million. It would have been gone in a week. You buy a house, a couple of cars, and go on a vacation. You're done. Isn't it? You are listening to No Lazy Money here on 760 WJR. My good friends Nick Hopwood and Jim Pilat, President and Vice President of Peak Wealth Management in Plymouth. If you would like a complimentary annuity review, reach out to Nick. It's Nick at peakwm.com. Nick at peakwm.com. Let's talk about sequence of returns risk, and we talk about retiring and the worst time to retire in the last 100 years. What would you say to that question?
Well, I think of my mom, who retired in fall of 2007, right before the big crash of 2008, all-time high in the market. And remember, it grinded back from 2000, from the 2000 high down to 2003, from 03 back up to 07. Finally, a new all-time high. You ring the register, you put in for retirement, and then boom, S&P is down 50% again. So like when I read this Barron's article, that was my guess that leading into the article that it was going to be that 2007 would be the worst time in the last 100 years to retire. However, turned out it wasn't 2007. It wasn't March of 2000. This is all our recency bias, right?
All of it is recency bias.
It wasn't even 1929.
Story of my life, recency bias.
But you think, okay, well, surely 1929 would have been an unlucky time to retire. The Dow went down like 89% or something crazy. But the real answer is 1968.
Really?
So we had a lost decade of the 70s. Okay, so just like the 2000s, zero return for the S&P, but we also had double-digit inflation for the whole time period.
Wow.
Right, so
I wouldn't have guessed that.
Exactly. When you combine the terrible market and the terrible inflation, that, according to Barron's, was the worst time to retire because you lose your purchasing power and your portfolio can't grow.
You mentioned that K-shaped economy earlier in the conversation. Is that kind of what people may be experiencing now, perhaps a little bit? Like if you're right there on the edge, maybe you're living on Social Security. You talk about that purchasing power, Jim. Your purchasing power, if you're just simply living on Social Security, is pretty difficult right now.
Yeah, absolutely. And that's why, inflation is such an issue, right? And obviously it's gotten better. But recently it's ticked up again a little bit with fuel prices being high. And that's where we see all those little things really affecting a lot of people. And it affects, the fixed income, right? They're on a fixed budget type people a little bit harder because now when you're, paying 30-40% more at the pump than you were last year, you feel that a lot more. We
talk about controlling the controllables, control what you can control. And one of the things people cannot control, though, is their age. If you're coming up against retirement, you do have some concerns about where we are right now. And you do look through the course of history, look through the course of the last 100 years from 1929. We have had periods before that were not great. You just rattled off several different years of that. What should people be looking forward to now? What can people control now if you are looking at retirement?
It's a great way to frame the question because, we can't control what the market's going to do immediately after we retire. Mm-hmm. So we have to stress test and we have to run the calculations, 1,000 different times to see if we do have a bad sequence of returns for the first several years of retirement, will the portfolio have enough critical mass to sustain itself? So that's what we do with all of our clients before retirement, before we give them the stamp of approval, is run it 1,000 different ways and make sure that they're going to make it through even if we have bad returns to start out. And the reason why we do it that way is because if you imagine, like my mom in 2007, all of a sudden you fast forward to 2009, and her portfolio could be down, a quarter or a third or even worse.
And you're hyperventilating at that point, I would imagine.
Depending on how risky you were, right? Yes, so you're hyperventilating, and she was actually too young for Social Security. She was 57. I think I would like to retire.
Yeah, I would too.
But her portfolio is down dramatically, and she's relying on it for 100% of her expenses, of her income. So it was a tough position to be in, but we did the planning. We ran it 1,000 different ways, and we were confident that 100% probability of success, that she would have 100% probability of success.
Jim, if you do run these 1,000 times or whatever the case may be, are there indicators where you're like, okay, this is a healthy portfolio, regardless, this portfolio here can really weather a storm for an elongated period of time? Is that a dollar amount, or is that a percentage of spending? What would be a good indicator there?
Usually it comes down to withdrawal rate. How much do you have to take out of the portfolio? So what can be a problem, some people might be listening to this and say, well, I am not going to get stuck in that and have these bad returns to start, so I'm going to put it all safe right now. Well, that creates a lot of issues, right? Because now if you're only making, 3% in a dividend type portfolio, or you put it in that annuity we talked about earlier,
3.5%,
you're only making 3.5%,
maybe,
but you're pulling out 4.5%, 5%. Like, you're only going backwards, right? So there has to be something in that portfolio that still continues to grow and keeps the portfolio from shrinking year after year.
Is that the question that people would always ask you, though, is like, when can I retire? Yeah,
it's when can I retire? At what income level can I retire? And how much will be left? I want to make sure I'm not going to run out, right? That's always the first, right? Safety, security, comfort question. But then it's like, well, how much could I spend? And how much would be left for legacy? But to piggyback on what Jim just said, with withdrawal rates and with portfolio going down, we have a program called Peak Income Conductor. And so what we do is we have a year or two of cash. So Ryan, if you're retiring tomorrow and you say, I'm going to need, X amount in withdrawal over the next 2 years, we would set that amount aside. And if we do have a bear market, right as soon as you retire, just like my mother, you're going to be able to make these 2 years of withdrawals without having to sell anything that's down. And usually, most bear markets have recovered by 2 years. Not the 2008 one,
right?
But most, on average, will be back. And then we didn't have to sell anything when it was down.
The planning of this is so crucial, and I think that's one of the things that we want to do with this show is teach people and help people understand how crucial planning is when it's good, so you're maximizing your money, when it's bad, so you can weather any storm that potentially is out there. And even, we talk about taxes a lot too. I mean, is there ever really a time that's not volatile or 1 day away or one decision away from, the markets or the news cycles really determining which way the market goes on this stuff? Planning is so key.
It is. And I think that it's pretty easy stuff, right? I say that from my seat.
It takes discipline though, Nick. People need that.
Right. But most people will shoot themselves in the foot with an emotional decision.
Yes.
Right. It's just kind of off the cuff, based on emotions, and they're forgetting about all that we've talked about and what we've learned. Our job is to help make sure at a certain point that doesn't happen to you.
Without question. And you are listening to No Lazy Money here on 760 WJR. I'm Ryan Ermanni, along with my friends Nick Hopwood, the president of Peak Wealth Management in Plymouth. Jim Pilat is the vice president of Peak Wealth Management. We invite you to reach out to these fine gentlemen if you wish. Nick at peakwm.com. Nick at peakwm.com. Jim, what is your email? I always say Nick's. What is your email address if people want to get in touch with you?
Tough, man.
Yeah, good luck figuring this one out. It's Jim at peakwm.com.
And look at that, Jim at peakwm.com. My goodness, we like easy, right? We like easy. One of the things that's not so easy to people out there, but maybe easy to you fine gentlemen, derivative income is the new dividend income. Explain.
Well, when I heard someone say this, I said, wow, that has a nice ring to it. Derivative income. Most people don't know what a derivative is. So it's advanced. It's not for all people, but it means options. Okay. Most people have heard of options, but maybe are uncertain what they are. Well, we have call options and put options. I'll spare you the details. But
I think I was in a Jan Gerson lecture on put options at some point.
Jan probably needs to hear about our covered call strategy.
Right. I go right back to 2000.
So derivatives are options, and it's a way to collect, in other words, some extra income. Okay. So right now we're looking at, I pulled up some dividend rates here. The S&P is at a 1.1% dividend yield. It's about as low as I can remember it in my career. The dividend aristocrats are in the 3% range. Those are companies that grow their dividends every year. Schwab has a really popular dividend ETF that's at 3.2%. There's just not a lot of income out there for stock investors. Now, we talked about fixed income in the prior segment and annuities and stuff like that. In fixed income, we can make 5%, but that's it, right? There's no potential.
Right.
You're just making that 5. It's steady. It's relatively safe. And it's good income, but on the stock side, we're kind of starving for yield. So we enter derivatives, options. So there's become a lot of interest in this area, especially on Twitter. I go down that rabbit hole.
Oh, who doesn't, right? I mean, who doesn't? I'm like, what's out there, baby? What's going on tonight?
A ton of ETF providers are thinking of every which way they can do option strategies to generate yield, right? And so it's gotten a lot of people's attention. There's a lot of yields that are like 35% or more. You got to stay away from those, okay? That's a hard stop.
Right.
If it's too high, it's too good to be true.
If it is too good to be true, if it sounds too good to be true, it usually is. Usually.
But there are reputable companies like JP Morgan, among others, who are rolling out ETFs with really good income, right, Jim?
Yeah, absolutely. I think that's the key, leaning on reputable strategists, people that have experience and a track record in it. But yeah, if they can implement these strategies where we're selling puts, selling calls, generating income, we've seen the income on these be high single digits, even into low double digits.
What would you say to somebody listening right now that really wants what are the right questions to ask? Again, if you're trying to work with somebody, you're interested in something like this.
Well, we like to take a total return approach, which means we're not, just buying for the dividend.
Sure. Great point.
Because then you end up kind of sabotaging yourself.
That's that holistic approach we talk about.
Absolutely. So total return, we need growth, but we also need income. And this is a way to kind of have a hybrid position where you do track the market to a certain extent, but you're also selling calls and selling puts, so you're getting a little juiced yield. And so, 7%, 9%, this is pretty reasonable from what we've seen. And for people that are looking for income, that really think compartmentally, they think I don't want to be selling shares each month. I need this income. I need this yield. This is a possible solution. This is not advice for anyone specifically, just general educational commentary, but it could be a solution for some people, but it's not the only solution.
Do you find people who are not gamblers, but essentially they really like to be aggressive with a portfolio, would go down this road?
Yeah, they can become obsessed
Yes.
over this high dividend
Yes.
yield, and
That's a great way to put it.
and put too much money into it, and then something goes wrong, and now
Now it's your fault.
they get emotional. Now they flip it, they sell, they take the loss, they move on, and we're just spinning our tires here.
Yeah, I would say where I would be concerned is people who think they're being conservative by investing in this. They're thinking, oh, it's just dividends, so it'll be fine. Because the reality is if the market swings big one way or another, there is potential that there's some price volatility. So I think that, fortunately, it would be offset by the yield that we're able to generate. So it is less volatile than a full market exposure type portfolio. But I think for somebody to get into it thinking it's like safe like bonds wouldn't be accurate.
Man, I hear you guys talk, and we've been doing this show for several months now, and it's always interesting to me the way people treat their own money, and it is always different. The personality of somebody that walks into the office and has this much money, X amount of dollars, and expects X amount of return or wants to spend. I feel like fiduciaries, financial advisors need like minors in psychology or something like that, because the personality of the client essentially could determine whether or not A, it's a good working relationship, but B, how much money they're going to have in retirement as well.
Yeah, I do feel like we could have a minor, in what is it, a BA in psychology, right? Minor. So, there's the marriage counseling part,
Yeah.
where the husband and wife don't always agree on things, and we have to try and finesse.
Absolutely.
But then behavioral finance is a growing field as well, and there's big studies going on in different universities on that topic. So, totally agree. Now, one thing about options, okay, is that if you have an up market, you're not going to keep up with that bull market. Like last year, if you were running these option strategies, you might have made a double-digit return, but you did not keep up with the S&P. Now, if you think about a down year, like 22, down bad, well, then you're going to probably outperform because the option income helps you lose less.
Right.
Right? But you're still down, but you've lost less. When these are the perfect, I can't say that. When these are a really good investment option is when the market is going sideways for a long time, where there's really like the car's spinning its tires. You have the option income kicking in each month. So you are making a return even though the underlying investments are flat.
This market that we're in right now, it feels like we're every close seems like it's a new high. And people are, well, I want to wait until it bottoms out a little bit. What do you say to that person? I mean, you got to get in, right? You got to get in.
Like you said, every day is a new all-time high. Okay, so for people that have like a lump sum pension or something, or a large windfall, a big bonus, maybe an inheritance, maybe they sold a house, whatever the case may be, you can put it all in one day. But my instinct is to do a dollar cost average program, and most likely over the next 6 months or a year, you're going to have an opportunity to buy at lower prices than we have today.
The one thing I'll add, Peter Lynch, really, really good stock picker. One of his quotes that I think is so true. He says, more money has been lost waiting for a bear market than has ever been lost in a bear market. So I think it's, like Nick said, there's a strategy to put money to work, but to just sit back and wait. I mean, I know people that sit back and wait, and then 22 happened, and guess what? They didn't get in. And then market's been running again, and now we're at all-time highs.
Jim, at one point in 22, the market was down 27%.
Yeah.
So what are you waiting for, right? That's a great time to buy,
right.
But we always convince ourselves
it's going to go lower.
There's going to be a better chance. Yeah.
That is Nick Hopwood, the president of Peak Wealth Management, and Jim Pilat, the vice president of Peak Wealth Management. Nick at peakwm.com if you want to get a hold of Nick, and of course, Jim at peakwm.com as well. Some great, easy email addresses to reach you fellas at for all this fine analysis. This is No Lazy Money here on 760 WJR. Fellas, as we enter our last segment, our last topic, talk to me about teachers and educators. A certain company wants to lock them up for 10 years. What do we know about this?
We have to be careful with
naming names.
Yeah, but this is a company everyone knows. They hold themselves out, promoting, the good for all or something like that. And usually we find them in universities. So could be doctors, nurses, professors, even the janitor at the university is investing with this company. And we had a woman who's 82 years old come to see us a couple weeks ago. She was a nurse, and her whole life savings was with this company, okay? And it was all in their traditional program, which is just a low 3% interest rate. So all the money is just earning 3%, which is disappointing when you think about what it could have made. But to make matters worse, she wanted to move the money to us for us to manage it for her. Guess what? She's locked up for 10 years. This woman is 82 years old. What if she needed that money not to transfer to us, but for her, right? They only have a 10% free withdrawal rate, okay? She's got to wait 9 years to get this money completely out. So that's a real problem for me. Makes me very angry.
And there's no outs. She's got no outs.
It's a contract.
Yeah.
Secondly, this woman's 82 years old. So she was required minimum distribution, RMD requirement started at age 70 and a half for her 12 years ago. Guess what? No withdrawals were taken over the last 12 years. So there's no advisor relationship. There's just 1-800-XYZ, and there's no real help going on here. Okay.
So she's just got no recourse. I mean, unless she wants to.
I hope she doesn't get audited, right?
Right.
Because she had to take out, if she has 500 grand, she had to take out about 20 grand a year or more.
Mm-hmm.
So times 12 years, that's like 250,000. The tax would be 125,000.
Wow.
The penalty on that. The penalty would be 125,000.
And I know we're not naming any companies, but how do you get away with that? I mean, that's like that. It feels, I'll say it, criminal. It feels that way anyway.
Yeah, I can't make any accusations, but
Sure,
it does feel that
of
way.
course.
I feel awful.
not.
I feel awful.
But it points to, a big issue though, where people invest in their 401k, their 403b, their 457, and they think they're doing the right thing because that's what they were told to do. And you think the company, they're looking after it, right? But they're not. I mean, this is a perfect example of how they don't do it. They don't look after it. They're not doing the little things. I mean, the RMD is a huge miss. Like the fact that company doesn't have something in place to notify them that this needs to be happening is crazy. But there's lots of reasons people have money in their 401s while they work there. There's always a question: should they roll it over into an IRA afterwards? Should they keep it there? That's one good reason for rollovers. Take it back under your control, where you have somebody there, like Nick or I, to help look at it, make sure you're not making these big mistakes.
For look, this person is 82 years old. The older the people are, really need an extra set of eyes on this though too, right? Is that where family and maybe even friends, really consult with people that love you as well?
Yeah, and that's exactly what happened here. I'm friends with her daughter, and so she brought her mother in to see us, and she had no idea, right? The daughter didn't know all of these intricate rules that her mother was not following, right?
And probably too with a lot of the older generation, you never talked about money. It's always such a taboo topic as well. So you're not going to talk about these things with your family or certainly your friends. But even your family, a lot of the conversations are not taking place in that, older generation.
She would have been, taking screenshots and posting to Twitter. Like, we could have helped her years ago, right?
It doesn't happen, right? Yeah, the kids today, right. Yeah, they don't do that anymore. But
if you're over 40, you're not taking screenshots.
I do think that that's one of the good things about this younger generation, though, is they do talk about money and investing and finance and compounding interest and all different kinds of things that we never even mentioned before, maybe even 10 years ago.
It's true. Yeah, less taboo, more out there. I think we can use this case though as a learning example, as a learning lesson, and say, like Jim said, hey, maybe we need to roll over to an IRA. Maybe we need some sort of consultant to help me make sure I'm following the rules. Maybe I need to start this 10-year withdrawal process earlier, maybe even at 55 or 65 instead of 82. Maybe I need to actually invest for some risk so I'm not stuck making 3%, which is only inflation, for my entire retirement. Right? This 500,000 could have been probably worth $2 million.
And maybe this is a good wake-up call too, Jim, for people out there that maybe have aging parents and if you are not intricately involved in your parents' finances, maybe sit down and say, hey, can we take a look at some of this stuff and just have a conversation about it?
Yeah, I think just approaching it from the direction of, hey, I just want to make sure you're all set. I heard these guys on the radio and they made some really good points. I think a lot of times people are guarded like that because, people just, they want my money.
Right.
I don't want your money. I just want to make sure that you're okay, that you're set, that you're doing the right things.
And conversely, if you are maybe an older person looking at this and you haven't really discussed your finances with a loved one, a son or daughter, or even a niece or nephew, maybe it's, hey, can we have a conversation about this? Communication is 90% of it. I mean, so much of what we talk about is people that are, for lack of a better way to say, in trouble financially because they don't talk about it. They just kind of do things without really knowing.
We could actually take it in the opposite direction and say, like this woman was making the lockdown 3%. Some older folks are so aggressive. When I see what they're holding, I can't even believe it. They're so aggressive and they don't even realize it, right? The portfolio could really be smacked, and it could be much more painful than they really need to, more aggressive than they really need to be.
Right. It sneaks up on them quickly. In the final minute, gentlemen, just an overriding message, theme of the night to you, 30 seconds maybe from both of you.
Well, we started off talking about annuity hell, right? So send us an email, nick@peakwm.com, if you feel like you're in a bad annuity, if you feel like you've been sold something that really has not delivered like you expect. You might be committed for a few years, but you might have an out. There could be an opportunity to make a change.
The only thing I would say, I think with a lot of the topics we talked about today is second opinions, getting second opinions, making sure you're doing the right thing, making sure you're not trapped in a bad situation. Don't be afraid to get that second opinion.
And one of the things for me too, that, as we look at the volatility of the news cycle, but the steadiness of the market, patience. It is always a good reminder to me to be patient out there, especially if you have holdings in there. If you are not in this market, I think, Jim, you said it, like more money has been lost by people waiting for a bear market than people who actually are in the market and then get hit by the bear market. Gentlemen, this has been absolutely fantastic. As the weather gets nice out, it is a good reminder to enjoy yourselves a little bit, and any good message for the people out there to enjoy themselves in these summer months.
Go for a boat ride, Ryan.
Yeah, let's go. Are we going on your boat?
It's a little late. It's a little late tonight, but tomorrow night.
All right. If you missed any part of the show, it will be on the Peak Wealth Management YouTube channel. If you want to watch us, feel free to do so. We're three handsome gentlemen, I think, having a conversation about money. You can check out the Peak Wealth Management YouTube channel at youtube.com/peakwealthmgmt. Peak Wealth MGMT. So we'll be up there on YouTube if you'd like to watch. Also, we are here monthly. If you would like to reach out to Nick or Jim, peakwealthmanagement.com,
peakwm.com.
peakwm.com. I should know that.
WJR.
I should know that. I've said it enough. And of course, Nick Hopwood, Jim Pilat, we absolutely appreciate you guys. May you hit the golf ball straight. May you drive your boat not over waves, but through them. Enjoy yourselves. Until next time, Nick Hopwood, Jim Pilat, Peak Wealth Management. I'm Ryan Ermanni saying so long. This is 760 WJR.